There are products out there that lots of people both own and hate. Life insurance seems to be one of those products. Whole life insurance, in particular, and its variants have probably one of the worst reputations amongst all the choices you've got for life insurance. But my guest today sees it a bit differently. He's a financial advisor who has found some good uses for life insurance for, wait for it, while you're still alive. Does that sound counterintuitive? I know it does to most people. I know it did to me before I started talking with him over time. Well, if you're curious, then listen to this episode. I'm Carl White, principal at Mark Advisory Group, which is a healthcare marketing agency, and I'm also the host of Practice Care. The mission for both is the same, and that's to help private practice owners stay private. That's usually what they want, but care is better when it's the providers of care who own the place, because any decision that's made, clinical, business, whatever it may be, is made by those who have to turn around and take care of patients. So we can feel pretty confident that the needs of patients are always top of mind. My guest today, another returning guest, is Drew Powers. Drew is the founder of Powers Financial Group, a registered investment advisor. He specializes in advanced insurance and investment strategies for doctors. Drew is 100% independent, which means he doesn't work with any investment or insurance company, and that means he's able to give unbiased advice that's most beneficial for his clients. He started his career in 2001 as a market maker on the Chicago Board Options Exchange, where he managed trading portfolios comprising hundreds of equity and equity index options listings. In 2008, he transitioned to the role of financial advisor and investment advisor representative, where he helped clients develop individual financial strategies. At Powers Financial Group, Drew leverages his stock and options trading expertise with his financial advising experience to help clients increase and protect their wealth. He lives in the Chicago suburb of Naperville with his wife and the two kids. He's an avid downhill skier, active in youth sports, a proud air quotes rooster within the Naperville Jaycees, passionate about CrossFit and the Paleo Primal Lifestyle. A lot going on there, Drew. Welcome back.
Thanks for having me, Carl. Always love being here.
Yeah, big skier. I know this. You're gonna have to travel Chicago land. I mean, we're in the tail end of the second summer. It's not snowing anytime soon. I hope you
Right.
can be patient. But
I have to be.
yeah,
We have no
you have no
choice in the
choice.
Midwest,
That's
right?
right. Go to Alaska or wait your turn. Um, okay, so we're going to talk about the living benefits of life insurance, which is amazingly counterintuitive.
Hmm.
But before we do that, fill in the gaps on you. It's a pretty good bio, but just tell us a bit more about you for those who haven't heard another episode.
Sure. Well, I would invite everybody to listen to our last episode because you really let me geek out there
Yeah.
and
A
let
taste of
loose.
Drew, ladies and gentlemen, a taste of Drew.
Yes, right. Oh, but like you said, I think the things that make me a little bit different as a financial advisor is number one, I'm completely independent. I don't work for an insurance company. I don't work for an investment company. I'm not beholden to a broker dealer with proprietary products. And my practice really does involve a lot of insurance planning, investment management, and mixing those two together.
Mhm. Which is, I've seen your presentations. Listeners, I will tell you that this Drew is the first one to actually explain things in a way where you go, I'm not totally lost. I think I follow what he's saying, which is no easy feat. So let's get into this. One of the things that it hit me one day after listening to you talk about whole life insurance is that probably one of the worst things that ever happened to it is the name that it was given, which is life insurance, because we all
Mhm.
think of, we all know term life insurance, which has one use, which is pay out something should you die, prematurely. Very simple. But what are the different types of life insurance? Because there's term and then there's a lot of flavors of, the whole. So just lay it out for us.
Sure, sure. So yeah, everybody understands term 10, 20, 30 year, kind of like renting it,
Yeah.
super inexpensive, and it's there for that term of time, and then it basically goes away, or it gets
Mhm.
so expensive nobody would keep it. Then
Right.
I love that you keep calling it whole life.
Yeah, sorry. That
Because
wasn't
I,
planted.
right. No, 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 that's okay. That's okay. Because this is a common misconception because for a long time, whole life insurance was the only type of what we're now going to call permanent life insurance.
Okay.
So, term being a limited term of time, permanent meaning it is there in theory, for your entire life,
Hmm.
and that you are going to pass away someday and it is going to pay out. Um, Underneath that permanent umbrella, then you have things like whole life or adjustable life, variable life,
Mm.
universal life, indexed life, and then those terms can be mixed and matched themselves. So whole life is one type of permanent life insurance. I I like to say there's no bad life insurance. There's just the improper situation for that policy. How about
Okay.
that? Is that fair?
That's good.
Okay.
Yeah. Everything's a tool. A tool has its place.
Right.
When
Right.
tools are, suggested to be useful in all sorts of unrelated situation is where your spidey sense goes up and goes, I don't know. I don't even know what this
Yeah.
is, but that just doesn't sound right.
Right.
Maybe term should be renamed temporary. So like is
Sure.
permanent sort of the accepted industry word?
Yeah, you'll hear permanent life insurance. You'll hear cash value life
Cash.
insurance
Mm-hmm.
because that is a feature of permanent life insurance.
Mm-hmm.
Um, but
But
yeah,
that's a
those are the
yeah.
two main terms you're going to hear,
Yeah.
right? And we know that the main use of all life insurance, whether that's term or permanent, is death benefit.
Mm-hmm.
So, Carl, you or I pass away and we have heirs that we want to take care of or leave money to charity, or maybe we have estate taxes, right? So, there is this money that gets paid out from this policy, but it's all, of course, after we pass, right? It's
Right.
all after we die.
Right.
And I think the other part of this, if we're just thinking about insurance in the normal way, we typically try to pay the least amount possible
Mm-hmm.
to accomplish that goal. So
Mm-hmm.
get the most death benefit for the least amount of money is typically the goal.
Right, right. But here we are talking about the living benefits of life insurance. So
Right.
using life insurance, who that has a lot of misconceptions, a lot of misunderstanding, a lot of bias, and has a
Hmm.
reflexive thinking of you shouldn't use it, can't use it, won't use it until you're already dead.
Hmm.
Here we are talking about the living benefits of life insurance. What the hell do you mean by that?
Right. Right. So take all those concepts we just put out and flip them completely on their head. So
Hmm.
in this case, what we're going to try to do is, you know, instead of getting the most amount of death benefit for the least amount of money, maybe what we want to do is have a small death benefit, put as much money as we can, pay as much premium as we can, and
Hmm.
try to maximize the tax advantages of life insurance.
Mm.
We can add benefits, right? Sort of the main focus of our talk here, add benefits to the life insurance that you can actually use while you are living.
Okay.
And then we should also understand this is almost always going to be a permanent policy. The uses for term insurance in what we're going to talk about are very limited or maybe just a step in the process.
Yeah. Okay. So let's go through some examples. I think that,
Hmm.
examples in life always help. Obviously, a
Sure.
very painfully obvious statement. Um, but give us some examples of that. So but just before it sounds like the
Yeah.
the the reason to think about this is at least one of them is because there's some tax advantages to doing so,
Right.
right?
Right. Right.
Okay.
And
Is
that
that this
maybe
is
is
that
a
like is that like the central story of this, or is there more to it than just that?
well, I think that can be the central story, but let me save that for a later example.
Okay.
Let's go with a super easy one.
Okay.
And this is one that I've run into a handful of times over the years. And this is where I'm going to call, grandma and grandpa have a pile of money.
Hmm.
And that pile of money is sitting in a passbook savings account or in CDs or whatever, and that money is earmarked to leave to the kids when they pass away.
Hmm.
Now, right now, what is a high yield savings account paying? 4% ish.
Tops.
Uh, Not terrible in terms of a bank account, but for 15 years, we had nearly zero interest rates.
Hmm.
So what you had was this big asset that they didn't want to invest because they didn't want it to go down,
Hmm.
right? They wanted the FDIC insurance on it or whatever, right? And This was earmarked to go to the kids, so they never touched it.
Mhm.
So sometimes what I'll say is, okay, you've got this big pile of money. You're not using it. You're not touching it. Here's a simple use for life insurance
Okay.
that kind of leverages the traditional death benefit planning.
Hmm.
What if we took half of that money,
Hmm.
paid one big premium, and bought a life insurance policy that equaled the number? So let's say they had $300,000 in an account,
Hmm.
and this is earmarked for the kids. Well, what if we took 150,000 of it, give or take, whatever the number is,
Right.
and we bought a $300,000 life insurance policy?
Mm.
Now you've got your $300,000 bucket
Yeah.
of money that's going to be left to the kids, and you've got another 150,000 in our example left over.
Hmm.
Go spend it.
Hmm.
Go take that vacation.
Hmm.
You know, finally go out to dinner or
Right.
do
Or
whatever
leave
you
it there and
haven't
give
been
your kids
doing.
more. Yeah.
Right, right, right. Or take the whole 300,000. Maybe you get 600,000 of life insurance.
Hmm.
All right, now we've leveraged it.
Hmm.
So, here's a situation where you know, we've had money that's kind of been locked down, and now we have freed it up, or at least a portion of it, by doing some traditional death benefit planning.
Okay.
So I feel like that's an easy first step. It puts our toes in the
Yeah.
water here.
And then, so while it's if it's sitting in the CDs every year, whatever interest is taxable,
Hmm.
right? But if it's
Hmm.
sitting in the life insurance policy instead, are you saying it's no longer going to get taxed?
Right, right. So life insurance does have a number of tax advantages, built in. It's written in the tax code.
Hmm.
Um, and as often as some of these things come up as a place where maybe, Congress is going to change, it is so far down the list. I think it's pretty safe. And the insurance industry has a pretty good lobby to
Fair,
keep
yeah.
these things going.
Yeah.
So, we talked about permanent insurance having a cash value component, right?
Hmm.
This side account, this investment inside of the policy.
Hmm.
Okay. And that money grows tax free.
Hmm.
So, right, whereas you're going to get a 1099 interest from those CDs, you're not going to get a 1099 when the cash value inside your life insurance policy grows.
Right.
Um, Life insurance benefits are not includable as income. Now, they may be includable in your estate, but they are not, includable as income. So, if someone passed away, Carl, and left you or I money, through life insurance, we're not going to pay income taxes on that.
Right.
And then you also have tax-free access to that cash value accumulation
Hmm.
through either cash value surrenders or policy loans.
Okay.
All right, so it's not as clean as maybe your good old-fashioned investment account,
Hmm.
but because of the tax advantages, it suddenly becomes interesting.
Okay. Is there like a simple example of each one that you can give?
Sure. Well, so let's talk about how you might build a policy, a
Okay.
life insurance policy for cash value accumulation.
Hmm.
Okay? You know that in order to have life insurance, you have to have some death benefit.
Hmm.
That death benefit is going to have a cost associated with it, right? The cost of insurance.
Hmm.
Well, the tax code also defines there are a couple of different tests, right? Mathematical formulas that say, well, you can have X amount of cash value per Y amount of death benefit.
Okay.
Okay. So our goal here is to maximize cash value accumulation inside that policy,
Hmm.
maximize the tax benefits of life insurance. And what do? We flip that whole term insurance concept on its head. Now we're buying the least amount of death benefit because we don't
Hmm.
really care about that.
Right.
What we care about is the least amount of death benefit and the most money we can stuff into that policy
Hmm.
and now have it growing in some fashion on a tax-free basis.
Right.
And then that money can be used pretty much at any time. It could be
Mm-hmm.
used for retirement. You could use it in your business. You could
Mm-hmm.
buy a car with it. You could fund your kid's wedding or college education. It doesn't matter.
Mm-hmm.
It's there for you. There's no 59 and a half rules. So there's some nice flexibility here, but it still has to be managed.
Sure. Okay. So we got a little, so we're going through some examples of using life
Mhm.
insurance while still alive. So we get the simple grandma and grandpa example, the kind of
Yeah,
entry level. And what's another one to help us
right.
grasp this?
Right. So let's talk about I'm sure that our listeners have heard about like certain concepts like be your own bank, infinite banking, family banking. It's this concept. We have to be very careful with that because I think that concept gets oversold.
Mm-hmm.
Um, but it if we design the policy correctly, what you could have is a very tax and cost efficient pile of money that you can invest in different ways. It can earn
Okay.
an interest rate. It can get interest based on an index. This is like an indexed policy. In a variable policy, you invested in mutual fund and ETF like products to be compliant once it's inside of a life insurance policy. We call it sub accounts, but for the lay person, these are basically mutual funds and ETFs.
Okay.
All right, so we can have this thing invested in any number of ways. It
Mm-hmm.
can grow over time, and then you can just go in and grab it, right, via a policy loan. It's a pretty simple process, but it has to be managed.
Mm-hmm.
You want to have the money in there first and borrow it and not be trying to. This is where be your own bank and infinite banking gets a little murky,
Okay.
where they're saying, "Hey, why don't you pay off your debts using life insurance that you haven't even built up yet?" So that's the wrong order. You have to build
Yeah.
up the money
Yeah.
first.
It's got to be there.
You know, so for instance, I have clients who, when it's time to buy a car, instead of going to the car dealership and doing their financing there, or instead of paying cash, they take it out of their life insurance policy.
Okay.
They give the money to the dealer, they take the car, and then they pay back their policy at
Okay.
whatever rate they want.
They can set their own interest rate.
They can set their own interest rate. They can set
Hmm.
their own timeline. In theory, you never have to pay it back. I would say in practice, you probably do to some point. But I've had clients who had opportunities to expand their practice
Okay.
or buy into a franchise, something that they wanted to invest in.
Mm-hmm.
And instead of going to the business banker, they borrowed it from their life insurance policy.
Hmm.
So what we're doing here though is the concept is that it's the minimum amount of death benefit. So all the time, I'll run into somebody, they've got a $3 million policy and they're putting in, you know, $1,000 a month.
Mm-hmm.
And I say, well, for $1,000 a month at your age, whatever that is, like you probably need a $500,000 policy. Why do you have a $3 million policy?
Mm-hmm.
And they don't know. They say, well, I don't know. That's just what the guy gave me. Um, you know, so we have to be careful. Are we designing this right?
Yeah.
Clearly, if you're paying for 3 million of life insurance, that's much more expensive than paying for 500,000 of life insurance, right?
Mm.
So more of your money is going to pay for insurance. That's not what we want. We want to maximize the cash value accumulation.
And just as a side question, let's say
Mhm.
that the monthly premium for the 500,000 was $300 a month. Could you pay more if you wanted to?
Yes, yes,
See, I got to
yes.
tell you, I wish I knew you because I don't know if I would have changed my answer or not, but a buddy of mine 25 years ago, 20 years ago,
Hmm.
floated this idea and he explained it to me. And I said, and it sounded like it was for retirement. I said, I just don't know that I can commit to that monthly premium lockstep forever, air quotes. What
Hmm.
if I can't? I default. And then what happens is like, well, you really can't default. But this concept of, you know, living benefits, use of this while still alive was never broached. And so,
Right,
like,
right.
if you're in a 401, if it's really for retirement or it's for death, if you're in a 401k or whatever, you could stop putting money in for a while because you, for whatever reason,
Hmm.
just pick right up again and there's no penalty or anything. It's just, but it didn't sound that like this is more flexibility. So you could still put in as much. Is there a ceiling? I imagine there's a ceiling on how much, maybe
There
not.
is, there is. So the tax code would say we'll have that formula and that
Okay.
testing to say how much can you put in.
Mm-hmm.
And in this scenario, our goal is to one, fund that policy right up to that IRS maximum,
Mm-hmm.
and two, have the right type of policy. So
Mm-hmm.
remember earlier we were talking about whole life versus universal life versus whatever else. Well, whole life is chock full of guarantees.
Okay.
Guaranteed death benefit, guaranteed premium, guaranteed cash value, some level of guaranteed cash value growth, and then the
Mm-hmm.
opportunity to get extra on top of that through dividends.
Okay.
Well, what do you know if you have all those guarantees? What do you know about it just intuitively?
Pricier.
Pricier, exactly. It's
Mm-hmm.
expensive and it's far less flexible. So you
Mm-hmm.
might have 20, 25 years ago been shown this concept in a whole life
Maybe.
policy,
Yeah.
which is fine. You just have to understand you're paying for all of those guarantees
Mm-hmm.
versus another policy that has stripped down all those guarantees and has instead make it very easy to basically, um, maximize your funding, right?
Mm-hmm.
Pay extra premiums into the policy, and they make it very easy to get your cash value back out,
Okay.
right? Much more flexible policy. So it's also about having the right policy for your goal in the situation.
Right. So now I get the concept of be your own bank. So you could be building up
Hmm.
money inside of this policy, and then you want to buy, or you want to, I don't know, expand your business, expand your
Right,
practice, go
right.
buy a new piece of equipment. Can you do that as an individual to buy something for your business, or is there like a different entities, you're the person versus it doesn't, or does that not matter?
I mean, that's a better question for the
Fair
CPAs,
enough.
but I'm
Yeah.
going to say I don't think it matters because I've had enough clients do it
Okay.
over the years
Okay.
that somebody's accounting for that personal influx of money into the
Right.
corporation somehow.
Right.
Um, but yeah, I would assume that that's something that the CPA handles on the bookkeeping end.
Yeah. It's an interesting
Mhm.
thought to put this away and say, we need to do an expansion or whatever. And then you
Right.
can borrow it from yourself or some of it from yourself, pay it back on your own timetable. That's
Hmm.
really interesting.
Hmm.
And when you take it out, it's tax free. And yeah, okay, really interesting. Hmm.
Yeah,
Um, what's another example? This is interesting
sure.
stuff.
So another example is something that I think is getting a little bit more press lately is long-term care planning.
Hmm.
So long-term care,
And how
think
angry
of
everybody is
this.
about what the costs of everything are. And,
Oh, right, right.
nobody's happy about this one.
Yeah. So let's back up.
Hmm.
When these first long-term care policies came out, the insurance companies used the same assumptions that they used for their life insurance policies.
Hmm.
And the same, especially like lapse and cancellation and conversion, changing the policies or whatever. They used all those same numbers. And then what happened was people never got rid of their long-term care policy.
Hmm.
Come hell or high water, they were going to pay that premium.
Hmm.
Because again, that was for them while they were alive, right?
Right.
It's a lot easier. It's a lot easier to justify that in our own minds.
Hmm.
So what happened? They had to increase pricing. Pricing was all over the place. People got huge price increases every single year. It was a mess.
Hmm.
I think that in the last 10 years, that industry, like the standalone long-term care insurance industry has settled down a bit.
Hmm.
I think they've got their pricing assumptions more in line, but it's still expensive.
Yeah.
So, what if instead of just buying a standalone long-term care policy, which there's nothing wrong with that,
Hmm.
it has its place, but there are also ways to add this to your life insurance.
Hmm.
So, what if you had a life insurance policy that allowed you to use the death benefit or even multiples of the death benefit if you had a long-term care need?
Hmm.
Sometimes when people hear long-term care, they think nursing home. And they say, well, I'm never going to a nursing home. I'm going to die in my Barca lounger. kind of
Yeah.
thing, right?
Yeah.
I'm going to stay right here in my living room. Well,
Yeah.
this is also at-home care.
Correct.
Basically, what long-term care is that if you've lost two activities of daily living,
Hmm.
you're going to qualify for long-term care.
Two of the six or cognitive decline. Yes.
Exactly.
Yeah.
Wow. Fantastic.
Hmm.
Yeah. So, you know, here's a situation where you could have a traditional life insurance policy with cash value and a what we'll call a long-term care access rider. It lets you access the death benefit, or a long-term care multiplier, right? So
Hmm.
there's long-term care if you live too long and you need it.
Hmm.
There's cash value in the policy. If you want to borrow from it or cancel the policy, you can take your cash value and go home.
Hmm.
And there's a death benefit if or when you pass away.
Hmm. Should you not use it? Yeah.
Right. So here's a situation where, you know, nobody's excited, I don't think, to pay for life insurance very often, right?
Hmm.
We're not typically excited about this.
No.
Uh,
No.
but and yet nobody got rid of their long-term care policies. So
Hmm.
here's a situation where we can combine the two.
Hmm.
And of course, it may not be as efficient in that cash value growth, right? Because now we're paying not just for the death benefit, but for the long-term care benefit.
Hmm.
Um, but again, if this was one of your goals, how could I plan for long-term care? And I don't want to run into the use it or lose it scenario
Hmm.
that traditional long-term care policies have,
Hmm.
right? If you pass away and never need long-term care, your long-term care policy never pays.
Yeah.
So this takes care of that.
Yeah.
Um, so once again, another living benefit, and somebody along the way is guaranteed to get the benefit of this, and it quite possibly you.
Yeah. What's neat about this is that because as you're talking about long-term care insurance, I have a little exposure to the long-term care insurance industry.
Hmm.
When people would say things like, I feel like I got gypped because I didn't use my long-term care, or it's expensive. What if I never use it? I look at them and I say to myself, it's insurance,
Right.
so
Right.
I have a disability policy. Do I
Yeah.
hope that I don't know, fall off my roof just so I can make a claim and feel like I got my premium money? Of course not.
Nope.
We have an umbrella on top of our home insurance. Do I hope that I get robbed just so I can call up my carriers and make a claim and feel like I got my money's worth? Of course not. And long-term care, and it's the same thing. You hope to God you never use it. What's neat about what you're talking about is that I think it flips it on its head also is the cash value that's sitting in there has um, good uses, potentially good uses,
Right.
very
Yeah.
familiar uses, things that are not so conceptually hard to understand. I want to expand my business. Wow, there's that pile of money sitting there that's free and clear, not free and clear, but under the right conditions, it's totally acceptable to tap into that. Um, and it's just, yeah, it's why I come back to probably the worst thing that ever happened to permanent life insurance is it was given the name life insurance, right along with term. So nobody thinks of it that way, and just all sorts of red flag warning signs that go up when people hear things like this,
Right.
because you've got a lot of people saying terrible idea, some people saying, are you sure that's legal? And one voice in the wind like you saying it's not necessarily a bad idea and it's totally legal as long as you follow the rules. And no, it's not good for every situation, just like any other tool. So I guess, dear listener, have an open mind about it. I mean,
Hmm.
I will say in our lives, my professional and personal life, we don't have any permanent life insurance. Um, Maybe back when that person had, framed it differently, you might have, I don't know.
Hmm.
But we don't, and that's fine. And, I don't feel like our financial lives are missing, but you never know. I mean, just
It's
don't,
never too late for you, Carl.
oh, well, thank you. Yes, that is true. That is true as long as there's breath in my lungs, I guess, right?
Right.
And my hand
Right.
can sign my name. Then yes, I too can act fast. But just be objective, and I guess I don't know how you answer this one, but
Hmm.
I mean, finding somebody who what I was going to ask you is, how do you find somebody who's just sort of responsible about talking about these things? And maybe it's just when they say things like, No, whole life and permanent life insurance is not good for every situation, of course, just like anything else. It's not. It
Right.
fits here, here, and there. And the conditions, rather than, oh no, it's fantastic. It's the, it is the one ointment you need for all your whatever. Like, how do you, and then finding someone who's qualified? Like, this is
Right.
not, uh, the Northwestern life insurance guy, not, fresh out of training. No. How do you find people who even know what they're talking about and are good at this? Like, how do you do that?
You listen to this
Yeah, I
podcast
guess that's right.
and you call the guests who are on it.
Yeah,
Yeah, it's difficult. It's
I
difficult,
know.
right? Because there are jokes in my industry. Like if you call certain companies and you say, "Hey, I've got $20 a month I'd like to put away and save. What could you do for me?" And they say, "Let me show you my whole life policy."
Oh,
If
Jesus,
you call
really?
them and you say, "I've got $20,000 a month I want to save. What should I do?" They say, "Let me show you my whole life policy."
Yeah.
It's the answer for everything, right?
Mm-hmm.
So, in a way, this is why I have strived to be independent
Mm-hmm.
because I was a career changer. And when I was looking at different firms to try to, start my new career with, when I saw the differences in payouts when I sold the home team's policy,
Mm.
and more specifically, the home team's whole life policy
Yeah, yeah, yeah.
versus another policy, I thought, well, how could I ever be impartial here?
Mm-hmm. Mm-hmm.
You're paying me 3 or 4 times as much on this product alone,
Mm-hmm.
right? So in a way, I think I this is why I became independent. I
Mm-hmm.
think you need somebody who doesn't work for an insurance company, doesn't work for an investment company. I think you need somebody who can get paid by, both ways on both
Yeah,
products.
yeah.
Because if I'm a pure insurance agent and the only way I make money is by selling insurance, then insurance is always the best solution, isn't it?
Right, right.
So yeah, it's a tough, you know,
Yeah,
question to answer
yeah,
definitively anyway.
yeah. No, I know. As I was asking, I'm like, this isn't a hard question to answer. I'm not sure it's answerable, but yes. Um, we hit a lot in not much
Yeah.
time at all. Anything you think we needed to touch on, we just didn't get to?
Well, like I mentioned, we've all heard about these cash value accumulation policies in a banking, like a family bank, be your own bank concept.
Hmm. Can you just explain what that is, just for
Yeah,
those, me
so the
included, who don't?
idea, right, it's the same idea that I'm posing, which is let's build up cash value. And then
Hmm.
instead of going to the bank and paying them 8%, why don't you borrow it from your policy, pay yourself back 8% and keep that money, or pay yourself back 4%,
Yeah, right.
right? And save the money. So,
Hmm.
but that concept gets way oversold.
Okay.
Again, because I think it's sold by a lot of folks who are insurance only
Hmm.
and just looking to capture more premium dollars.
Hmm.
When we build these policies correctly, I should really be getting paid very little because the death benefit should be small, and that's what I get paid based on.
Got it.
So we want to be careful when we get these concepts that are being sold. And I think on the long-term care side, there's traditional long-term care access riders where the agent has to be long-term care certified
Hmm.
to sell. That doesn't mean initials behind your name. It means that you've taken continuing ed and you've passed the classes to do it.
Okay.
There are also chronic illness riders. And a lot of chronic illness riders have been written in such a way that they mirror the definition of long-term care,
Okay.
but a lot of them haven't been written that way. They also, because it's a chronic illness rider, it doesn't have some of the same tax advantages that long-term care rider will have. So there could be some traps there along the way. It's probably too much for this podcast, but we want to be careful to, I'm
Yeah.
biased. I want everybody to have a long-term care access rider or multiplier,
Hmm.
not a chronic or critical illness,
Hmm.
because the long-term care is, I think, the gold standard.
Yeah. So that's if
Um,
you think you're going to contract a chronic illness, or you like you have to.
Yeah,
All insurance is kind of predicting the future, hoping to God you're
right.
wrong, and that you never
Yeah.
use it. So, yeah, is that essentially like you, for whatever reason, you
So,
say,
right.
I'm gonna need chronic illness coverage. That's
Well,
what
a
it
lot of
is.
them are written the same way. This is what I'm saying is it's sometimes it's oversold as the exact same as a long-term care rider, and it's
Okay.
not the exact same. So we need to be
Okay.
careful there.
Okay.
And that would be a much deeper
Fair
conversation. We could
enough.
do a whole show on that if you
Okay.
really wanted to put folks to sleep one day.
I'll put it on the idea board. How about
Yeah,
that?
right, exactly. Well, at the bottom, I'm sure.
Well, brainstorming, you don't want to kill any idea. So that's where we
Yeah,
are. Yes. All right. And then, for somebody who's, the scenario every episode caught a listener's attention, they just don't know where to start. They think, like what caught my attention was this, the banking concept without overusing it. Um, but how do I get started? What do I do? Where can they, what would you recommend? Just something to like, get them off the starting line and kind of get moving, either to a final decision to do or don't.
sure, sure. Well, I always like these, insurance for accumulation or the living benefits discussion. It's probably something like you're already funding your 401k because that sure is cheap and easy,
Mm-hmm.
right? You're
Mm-hmm.
probably already doing a Roth IRA strategy for all of our listeners, right? They're doing a Roth conversion.
Mm-hmm.
I hesitate to call it the backdoor Roth, but that's what everybody knows.
Mm-hmm.
The IRS just doesn't like that term. Um, this is kind of like that next level of planning. Maybe you've
Mm-hmm.
got a lot of term coverage and you're thinking, okay, I've got some more money. What's my next step in planning?
Mm-hmm.
Now we might talk about, are there additional ways that you'd like to be saving money on a tax preferred basis?
Okay.
Are there, is there additional money you'd like to put away for the possibility of long-term care, knowing that you can use it for long-term care? If you
Mm-hmm.
live too long, you can take the cash value if you want to cancel.
Mm-hmm.
And if you pass away without ever using either one, the death benefit is going to be paid out.
Mm-hmm.
I think this is kind of the next level of planning.
Okay.
If you've already purchased a policy with the idea that you were going to have this huge cash value amount that you were going to use in retirement or in this kind of banking concept or something like that, and you would like somebody to review it, I
Mm.
am always happy to do that.
Okay. See if it's the best it can be for you. Any
Right.
changes you can make.
Yep.
Got it.
Yep.
Okay, great. Perfect. I love these conversations. I really do. It's just, you know, every once in a while, my marketing brain, I think the worst thing that ever happened to that product was its name,
Yeah.
and that
Right.
just is never going to go away. So this, I think, is one of those examples. So thank you, plain language, for coming on once again and helping us understand something that is important but confusing all at the same time. So thank you.
Thank you, Carl.
We've got your contact information. They're in the show notes for this episode and every one of your episodes. So anybody whose interest has been picked by Drew, you now have another way to get a hold of them. Two quick points before we wrap up. If you're like Drew or us and you serve private practice owners regularly, or you're one yourself and you've got some experience on the business side of private practice, and do not overthink what that experience is. What you think is boring and easy and forgettable is not something you've figured out others are struggling with. Come on Practice Care and tell the world about it. There's a link in the show notes of Drew's episode and every episode. Take you a minute, click on it, tell us what's on your mind. We'll get you scheduled as soon as possible. And finally, subscribe to Practice Care. One word, Practice Care. We're everywhere. Apple, Spotify, you name it. Subscribe because we drop a new episode every week, and that's the easiest way to stay up to date. Thanks very much, and until next time.